This meeting is being recorded.
Great. Okay.
You can start, sir.
Yes. Okay, we'll start. So good evening, friends. So good evening to all of you. Yes. So shall I upload my presentations?
Good evening,
Right
sir.
now. Good evening. Ready. Very good. Good. Okay. I think I can also share my presentations today. Yes. Yes. Now, welcome to BFM subject, very important subject, Treasury Management in Banks. I think all of you are able to view the screen, friends. Yes or no? All of you are able to view the screen?
Yes, sir.
Very good. Okay. I will highly make it interactive. My request is once you interact, at that time only you unmute, then immediately without forgetting put mute button so that the background noise will will be minimum. Okay. Yes. So today, yes, we are starting Treasury, the basics, part 1. I think Treasury is also a specialized function of every bank, and every bank generates so much income, profits in Treasury operations. What is Treasury? Managing the money after giving loans. Deposits are our resources, and after giving loans, something will be in our hands, and we have to maintain SLR, CRR is a statutorily, we have to invest something out of our NDTL. NDTL means net demand term liabilities. We have to invest in SLR securities and CRR, cash with RBI, we have to maintain. So after that, we are giving some loans. And even after giving some loans, we'll be left with some money in our hands. That money again has to be invested carefully, profitably to generate more income for the bank. So that is why treasury management is very vital for every bank, because all of you know now this general lending has several issues like NPA. So NPA means there is a 3-way loss for the bank. You have to create provisions, you have to create capital adequacy, and you have to forget your interest income. So all these put pressure on the profits of the bank. So the banks, every bank wants to do something that is beyond lending. So that beyond lending is in the form of treasury management. Treasury is managing the funds, precious funds of the bank. So how they get the funds? Yes, they get the funds from current account, savings bank account, and time deposits. Refinance they avail from Reserve Bank of India, NABARD, ECGC, okay, some RBI. The refinance also a source of funds. Deposits are source of funds. And with the source of funds, they deploy the funds in the form of, first cash, something they have to keep cash. But cash doesn't generate any income for the bank because it is mandatory to keep some percentage of the NDTL. NDTL means net demand term liabilities. So the treasury, they invest the precious funds of the bank in very profitable avenues. Okay, so you can just I will use my pointer also. The various functions of the treasury, number one, they are primarily responsible for investing the surplus funds. The surplus funds would not be kept idle because the funds that is coming to the hands of the bank, every funds has got the cost. Maybe, of course, current account, we do not pay any interest, but there is servicing cost is there. So we have to generate some income to service our establishment expenses. So that is always known as what? NII. Net interest earning, net interest income. The net interest income for the bank is how much income? Oh, I think one terminal you have forgotten to mute. Okay, please. Otherwise, no, suddenly background noise. Yes. So the SLR investments, non-SLR investments, SLR mean, yes, statutory liquidity reserve ratio. So you have to compulsorily, mandatorily or statutorily invest some 18% of our NDTL in SLR securities. The 3% you have to keep in the form of cash. Some people, depending on the CD ratio in the sense, credit deposit ratio, how much percentage of deposits they are using for giving loans, short-term loan, long-term loan. So that is, after that, they will be left with some funds that will be used for what? Maybe investing in non-SLR securities like corporate bonds, okay, commercial paper, wherever they are likely to get more income, but they have to manage the risk also. I think the other day we discussed, sometimes when we likely to get more income, more interest, there is also a likelihood of risk is there. So you have to adjust both. So this is a technique, yes, treasury will, yes, adopt. Okay, so there are 4 functions are just for your, yes, information, because theory portion, I think you can easily understand. Treasury will not be there in every branch. It is a centralized activity of every bank. Okay, so the lending will be in every branch. Retail loans you will give, agri loans you will give, gold loans you will give, term loans you will give, CC loans you will give. All those will be at the every branch will have. But the treasury functions will not be there in every branch. But in treasury, it is at the centralized, your corporate, your macro office functions. SLR securities, they have to maintain because mandatorily every bank, otherwise they will be fined. What is the fine they have to pay? They don't maintain the required SLR, CRR. That also we are going to discuss. So it's a very fascinating subject is treasury management. You will get good score. Non-SLR securities, okay, which are non-SLR securities. Yes, the question we will go in question answer mode. Okay, non-SLR mean this high earning other than the government bonds, RBI treasury bills, okay, something which you have to invest that will qualify as SLR securities. SLR securities mean investments. The bank is profitably investing the funds because the funds of the depositors are very precious. Okay, so raising tier 1, tier 2, because you have to comply with the Basel III requirements, you should keep adequate capital. So this raising tier 1 bonds, the additional, that is perpetual bonds, tier 2 bonds, that is subordinated debts, tier 2 bonds mean debts, debt instrument, tier 1, tier 2. What is tier 1, tier 2? I think we will have discussed in maybe risk management, and you are going to discuss again in balance sheet management. So the forex transaction. So the treasury also, yes, sell derivative products. I think you will have heard about hedging products. That is futures. Okay, so currency futures, they will be intermediary and they will be trading in currencies, and they will be selling forward contracts, option contracts, currency swaps. What are those derivative products? Derivatives are nothing but hedging. Some risk factors you have to manage because in international transactions, there will be risk factors. But the treasury room will offer this product also. Supposing exporter will require a forward contract, Importer will need a forward contract. Supposing a borrower will need a product to manage the interest rate risk as well as exchange rate risk. So all these will be delivered by, yes, our treasury room. All fee-based income it will generate, future derivatives. Okay. So forex transaction normally looked after by international, but it will be the centralized desk will be there. Centralized dealing room. That is centralized dealing room in the sense, okay, every bank will not have, yes, regional dealing room, but the apex dealing room, most of the banks do have in Mumbai, because Mumbai is considered as the forest capital of India, also the economic capital. Okay, political capital may be, yes, Delhi, but economic and yes, other capital is Mumbai. So most of the dealing rooms are located in Mumbai. Okay, and derivative mean hedging instrument. So by selling these instruments to our valued customers, we generate more income. This is the background for treasury. Now we'll go in the funds management. They also maintain CRR, SLR, interbank money market transactions. They will participate in, okay, money market instruments, invest in money market instrument, like yes, CP, that is commercial paper, certificate of deposits, okay, interbank participatory certificates, okay, repo, reverse repo. These are all money market. Money market, there are, I think all of you remember, there are 5 markets mostly banks are investing. Just for your background knowledge, number 1 is equity markets. Equity market, most of the banks are not going because it's a highly risky market. That is share market. Okay. So there also some regulatory guidelines are there. Each bank can invest how much. Okay. So that also, yes, will be looked after by treasury. So most of the banks do not invest in shares, and they prefer debt market. The second market is, first market is equity market. They will invest in shares. They are permitted to invest. Okay. But to some extent, there are regulatory guidelines, exposure limits are there. Because if the money of the customers, they have to manage profitably. And when the demand is made, it is whose money we are managing. We are not, it is not our money. This is the money belonging to our depositors, our customers. So we have to manage in a very profitable way. The second market is debt market, also called as bond market, also called as fixed income market, because here you are investing in debt instrument, you are assured of some interest income, and also you have to analyze the risk factors. The bank treasury, it is not individually in the treasury management in banks mean is not individual treasury, individual funds are how they are managing. That is different. That retail investments. Here the bank as a whole, how they will invest in so many markets. First one, equity market, very carefully. Second one is known as debt market or bond market, and especially Government of India bonds. If they invest, it will serve 2 purposes. It will, okay, it will serve SLR requirement also when you are investing in Government of India bonds, or that is debt market. So it will serve the purpose of, even Government of India bonds are issued even for longest tenure, 40 years also. 40 years also, that's a maturity. The longest maturity for a government bond is, earlier it was 30 years. Now they are, yes, issuing Government of India bonds on a long-term bonds also. 40 years, the funds will be invested, but it will be safe. Correct, you are investing, anyhow, your bank has to maintain SLR. So by investing in a Government of India bond, 40 years bond, 30 years bond, 20 years bond, long-term bonds, 2 purposes are served. SLR also going to be maintained on an ongoing basis, and it is going to be risk-free investments for the bank. Okay, understood? Okay, the third market is money market instruments. That is money market, the debt market mean tenure, the maturity will be beyond 1 year. But the money market instruments will be 1 day to 1 year. Call money markets, repo, reverse repo, very interesting. The treasury, very simple. Here is again is like a international banking. This is a scoring subject for all of you. Just 2 formulas, 3 formulas. If you remember, you can score so much. We will learn together how to score so much in treasury. Okay, friends. So the basics, if you understand. So the third market is known as, that is money market. The maturity will be ranging from, that is this I am background here. No, I think you will. I will give you a simple one-liner questions afterwards. Okay. So here I am focusing on exam oriented, as if you are going to attend the exam. Okay. So I am giving you 5 minutes the background, so that today we'll deal with the 60 questions I have framed for today. Okay. So I think you are a quick learner. Well, yes, we will go slowly. But yes, once level 1 is over, you are comfortable with the basic concepts. Level 2, level 3, level 4, we will add more numeric problems also. Agreed? So the fourth market is, okay, yes, even commercial paper comes under money market, call money, repo, reverse repo. Okay, what is repo? What is reverse repo? How it helps? So many terminology you have to familiarize. Okay. Yes. So the fourth market is normally is a very profitable market again, forex markets. First market, equity market, normally you have to be very careful. Debt market, bond market, that is second market. Third market, money market, 1 day to 1 year instruments are being traded. So that is the liquidity, because it is easy to sell and get the cash in times of emergency. That is why it is called as money market. The fourth market is called as forex markets. So if you have got surplus rupee funds, you can convert to dollar and invest in dollar, or you have got more. Now so many banks are having integrated treasury. Integrated treasury means, so they have to manage rupee treasury, rupee funds also, dollar funds also, dollar or forex funds also, because so many banks are opening FCNR. Every bank is opening FCNR, EFC, RFC, RFCD. Okay, so they are generating assets, PCFC, EBR. Okay, so once you get a dollar deposit, you have to create dollar loans, short-term loans, and you have to be the treasury also responsible for what? So these are the four functions of four products. The four products are 4 areas where the treasury will be involved, and the 4 basic functions are ALM. This is one slide. We try to understand the whole. This I will share with all of you. The number one function, basic function is ALM. Treasury means, because assets are our loans, cash, that will appear in the balance sheet. The liabilities are our funds, the source of funds, where from we get the money, that is liability. So there will be sometimes mismatch. The mismatch will take place as far as maturity is concerned, because current account SP, it is payable on demand. But once you give a housing loan, okay, you cannot get back the money just by making demand. You locked up. Our funds are locked up. So every bank will have a ALM issues. ALM means assets liability management. The second is liquidity management. The ALM also includes interest rate management, because for deposits you are locking fixed rates, but all your advances are, all your loans are linked to, yes, some floating rate, benchmark rate, maybe RLLR, repo linked lending rate. Okay, so there are so many benchmarks, MIBOR linked, GSEC linked. So your lending rates will be linked to floating rates, but your deposits will be fixed. 10-year deposit means for 10 years you have to pay the same rate of interest. So there is a mismatch, possibility of mismatch. So that also is looked after by treasury room. Only some few people will be in treasury operation, but they will take care of the whole operation, treasury operations. Is very important for every bank. The second is liquidity management. Supposing there is a huge withdrawal from SP accounts and current accounts. Current account with SP account is a demand deposit. When they really want to withdraw, you should be able to pay back the money. Otherwise, the bank's image will be damaged. That is liquidity management. Okay, outflows, inflows. What is inflow? What is outflow? We are going to discuss. And SLR, CRR, this again is a mandatory for every bank. Every branch will not maintain. It is apex level function. So the apex level is the corporate office. That is a specialized activity. How much SLR need to be maintain, how much CRR you have to keep, funds you have to block, that is, you have to invest. This CRR is not an investment, it's a mandatory, you have to keep it because that will not give you any returns. But SLR, yes, once you invest certain funds, that the mandatory requirement is 18% of your NDTL in yes, your SLR. So that will earn you more income. Okay, and risk-free, Government of India. So that we will discuss. The fourth one is funds management. These are the basic function. Funds management means when they need money, they have to borrow money. For the bank as a whole, sometimes they will raising. They will be doing repo transaction. Repo is nothing but, yes, offering the securities, SLR securities to Reserve Bank of India, like your gold loan. Suppose you immediately want money for the bank as a whole. They want some 5,000 crores urgently to meet an emergency. So the securities available in their hand, unencumbered securities, they will pledge to Reserve Bank of India, and Reserve Bank of India will give them some loans, okay, short-term loan. That is now called as repo transaction. But similar way, whenever banks have got surplus funds, instead of giving loan, because immediately giving loan may not be possible, because you have to assess carefully. So pending disbursement of big loan, the temporary surplus they will park in reverse repo. Okay, so that arranging funds, utilizing funds, deploying funds, that again will be looked after by Treasury. Okay, friends. So this one slide, this I will share with you just to give an idea about what is basically Treasury, what are the market. Okay, now we'll go to the live questions. So question number one, what are interest sensitive liabilities of the bank? Interest sensitive. What does it mean? By the changes in interest, how this will affect the NII of the bank. I'll note down if you have got a pen. Yes, go on noting down the points, but that will go into your mind. Every banks work for NII. Note down. NII mean the difference between what you earn on your interest income minus interest expenditure. This is known as NII. Very simple. What is NII? The net interest income. Sometimes they will give you practical. Calculate the NII of the bank. What is NII? On advances, you earn income. SLR securities, agri loan, bill discounting, housing loan, retail loan. You are collecting interest collected. And SP, except current account, all other liabilities, sometimes refinance. Yes, some refinance, you have to pay interest. Okay, some funds may not. Okay, there may be some SL. Supposing ECGCS given you some settlement, that will be given in your, is a liability. But for that liability, you need not have to pay an interest. Some are risk sensitive, some are not sensitive. So RSL, this terminology will learn in balance sheet management also. So in treasury, what are interest sensitive liabilities? This is one theory question. Current account is not sensitive because any changes in interest, what is the meaning of risk sensitive? Any changes in interest rates, whether your NII will be affected. NII will not be affected because of current account. Current account, you do not pay interest. So A is not the, what are interest rate sensitive liabilities, RSL. Current account is not the answer. Savings account, yes, this is contributing. This is one of the, yes, source of funds where you have to pay interest. It's an interest expenditure. Time deposit, again expenditure. Here is the question is interest rate sensitive liabilities. So B and C are interest sensitive liabilities, whereas A is not at all sensitive. Why not at all sensitive? Because we don't pay any interest. Okay, so that will not affect your NII, interest income. Okay, that is question number one. So question number two, simple questions. I think you can easily understand. Some questions where you need to, yes, some elaboration is required. I think the basic questions you are familiar with. Okay. So question number two, what are interest sensitive assets of the bank? Okay. Some assets they will give you and you have to find out which are sensitive. Sensitive in the sense which will affect your interest income or NII. What is NII? Just now you understood. Interest income minus interest expenditure. Okay. So here the yes, cash and balance with RBI is not sensitive to interest because there is no interest. Because whatever you keep with the Reserve Bank of India is like a current account, and current account RBI will not give you an interest income. So B, fixed asset. Fixed assets mean land and building, furniture and fitting, and you are invested in software. So that is all will not give you any income. So B is not the answer. Loans and advances. Correct. It is sensitive to because now repo has been changed. So repo has gone up. So your all your advances will be again repriced. That is called as repricing. Repricing. This terminology they will use. Don't get confused. Repricing means changing the rate of interest. Either changing, yes, rate of interest will go up or come down. That is called as what? Repricing assets, repricing liabilities. That will be done by, again, treasury people only. That is one committee known as ALCO. That is Assets Liability Committee. Okay, so the general managers of a bank, they will be in a team, they will in a committee, they will look after this. Suppose there is a change in repo, then they will go active. Okay, then whether we need to change the rate of interest for deposits, SP, whether you have to change term deposit, different tenures are there. Okay, even 7-day term deposit there, 15 days, 10-year term deposits. Whether you have to change the rate of interest, that is repricing to attract more deposits to the bank. Okay, all those will be decided by treasury people only. Treasury is a very specialized activity. So loans and advances also sensitive. Interest branch, inter-branch accounts. Inter-branch account mean that is yes, that is not interest. Okay, that in also because there is a transfer pricing mechanism is there. But when you look at that, here bank doesn't pay interest for, yeah, that also counts, but that will for exam purpose for understanding RSA, that is not a RSA. Okay, so question number, the answer is C only. A is not interest rate sensitive assets. Fixed assets not at all sensitive because there is no question of paying yes, getting interest income because is a fixed assets. Okay, interbranch accounts that also will not generate any interest income. So the answer is C. That is understood. So question number 2. So question number 3, what constitutes, this is a question very often being asked. What constitutes is a risk management. There are so many risks you will have heard about. Okay, concentration risk, market risk, systematic risk, system, okay, so many embedded risk. So all those I think in risk management you will have discussed. But concerning treasury operation, there is one very important risk for every bank is interest rate mismatch risk of a bank. That's the mismatch. How it arises? They will give 4 options. 1, 2, 3, 4. You read all the option. Okay. There they will try to, I think all of you are familiar. Some of you may be repeaters or most of you, all of you have completed your JAB. The options, they will construct in such a way using very lengthy sentences, ultimately to, yes, to put pressure on you. But when you know the concept, quickly read the option. For example, what constitute liabilities at fixed rate of interest? Liabilities at fixed rate, correct. All our liabilities like term deposit, once you sign a contract, 5-year or 10-year deposit, in between we will not change unless the customer pre-close or again reinvest. So normally 10-year contract signed mean we will not change in between. Assets at floating rate, but all our assets are, early days it was different. Now from 1993 onwards, all our assets are also starting floating. Floating in the sense, whenever there is a change in policy rate, whenever there is a change in our benchmark rate, we will also change our overall lending rate to our customer. Housing loan will revise. So all your housing loans are linked to a benchmark rate. So whenever there is a change, either it will be increased or decreased. Whenever there is a downward trend in repo rates, we should also charge less for our retail customers. But now interest rates are moving up, mean again our, yes, loans and advances also will be repriced and more, yes, it will be at a different rate. Okay, increased rate. Okay, friends. So that A appears to be correct, but we read the option. Loans are at fixed rate. Loans are never at fixed rate. Our advances, our assets, not at fixed rate. Whereas deposits are floating. No, deposits are yet to come floating. And either situation, no, not either A or B. Loans and advances are floating rate. So that is not a mismatch. So the mismatch is A is the mismatch. The interest rate mismatch. Why interest rate mismatch? I think all of you are familiar. Okay, so the answer is A. Okay, it's a simple question. This also being asked. Maybe in JIB or CAIIB. It's a basic question. Okay, now question number 4. What is liquidity risk of a bank? This also you should remember. This question they are repeatedly asking. Liquidity risk. Because Treasury is mainly concerned with liquidity risk management, interest rate risk management, and funds management, SLR, CRR. There are basically, just we saw in the first slide, basic functions of treasury in every bank. Okay, what is liquidity risk of the bank? Now I will make you interact. Okay, because all along, I will give you the 4 options. Now you have to select the option. Read. I will read. Now within when we finish reading, one of you. But when the answer is over, immediately unmute. Okay. When maturing assets are less than maturing liabilities, maturing assets means what? So many housing loans will be repaid. So many investments will have become due for repayment, maturing investments, and the CC account. Okay, that will be. So these are all the repayments in loans that become what? Maturing assets. And maturing liabilities means what? Some time deposit may have become due during a particular bucket. I think 10 buckets are there. Overnight bucket, 2 to 7 days bucket, 8 to 14 days bucket. Bucket means tenure. So the bank automatically, software is designed in such a way, automatically will classify the assets and liabilities automatically, because the computerized function, how much deposits are due tomorrow, you will come to know. How much repayments we can expect tomorrow, you can come to know. So whether option A, option B, whether maturing assets are more than maturing liabilities, either of the situation A or B, both situation A and B. Either now C, D, A, B, which is the correct answer? So one of you or any of you, but immediately don't forget to put your yes, mute button. Yes, boss. Because I believe in interacting. Because if you go on hearing, now which you feel creates liquidity risk for a bank. Yes, boss.
Both
Very much.
situation A and B, sir.
Very good. Great. Okay. Yes. Anyhow, is a very, yes, that is important. Okay, boss. So the answer is D. Answer is D, both situations. Sometimes maturing, the money that comes to the hands of the bank will be more, but the bank has to pay little. The inflows will be more, outflows will be less. That also liquidity problem. Sometimes over liquidity, sometimes under liquidity. What is over liquidity means what? So many deposits are getting opened, and there is no demand for funds. No, bank is with so much money. You cannot keep the money idle. That is over liquidity. Sometimes under liquidity. So many depositors are withdrawing. But bank does not have enough money to meet the depositors' demands. So bank is sometimes in an embarrassing situation. The liquidity management will liquidity risk. If it is not managed, it will damage the fundamentals of banking. Bank's image will be damaged. So very correct. Both situation, yes, A and B, yes, constitute liquidity risk. Okay, very good. Okay, question number 5. What is positive gap in liquidity? This, yes. Sometimes there will be negative gap in liquidity. Okay. Now, on this also, I'll be happy. Yes. Okay. Now, what is positive gap in liquidity? 4 options are given. So, same way. Any one of you, all of you, try in rotation. So, you unmute. Okay. When maturing assets are, I will read. So that now, when I am reading, your mind should capture. Yes, immediately it should. When maturing assets are less than maturing liabilities, Maturing assets are less than maturing liability. That's a positive. Maturing assets are more than maturing liabilities. Either of situation A or B, both situation A and B. So now what will be the answer? Positive gap. Yes, boss. Anyone can. Yes. Yes, sir.
C, sir. C.
Other
C.
than C, yeah?
C.
Either of the situation A or B, yeah?
Yeah.
Huh?
Yeah. Yes, sir.
Answer
Answer is C.
C, yeah? Yes. All of you agree? Anybody, any disputes? So the answer is actually the answer is not A, boss. Maturing assets are less. Maturing liabilities. I think if you have got a pen, note down. Maturing assets inflow, note down. Maturing assets mean inflow of money. Maturing liabilities mean outflow of money. In the first situation, which is less, maturing assets are less. That is, inflows are less. Maturing liabilities are more. Outflows are more. That is not a positive gap. It's a negative gap actually. Second one you read, maturing assets are more. That means inflows are more. Note down, maturing assets mean inflows. Maturing liabilities mean outflows. This will help you in balance sheet related arithmetic also. Basic concept. So the correct answer is B, friends. Okay, what is the correct answer? Positive gap means bank is having funds, surplus funds in a particular bucket. There are 10 buckets in a particular bucket, and the bucket and all they will not tell. Generally, when there is a positive gap in liquidity. So the answer is B. Correct answer is B. Why correct answer? One example. One example I am giving, Bharat Bank. So in the box column, I am giving one example. Bharat Bank, 500 crore maturing assets. So it's an inflow. By way of loan repayment, so many people are repaying their installments, EMI, and maturing investment. Some investment they have made, treasury bills. So that is due. So RBI will give you money. So the bank gets inflows 500 during the next month. But maturing liabilities, the likely withdrawal from SP account, current account, even time deposit, likely withdrawal is 400 crore. Now, bank will be happy or unhappy? In that bucket, bank will be happy. Why banks are happy? It's a positive liquidity. Positive gap. It's a gap. It's not positive liquidity. Okay. Positive gap means bank is with money, not bank is out of money. Now, how many of you understood? This is very important, boss. Understood or not? Yes or no? It's a very important, boss. Very base.
Yes, sir.
Base part. Okay. Now come to question number 6. Now, similar way you have to answer. What is negative gap in the liquidity? I will give you similar way 4 option. Now, yes,
Option
all
A.
of you. Option
A.
A, correct.
A.
Yes. B, B illa.
Yes,
B
sir.
illa,
Yes, sir.
Yeah.
mattum
Now
sir.
you look at the, correct. Now maturing assets are less. That means inflows are less, but which is more? Maturing liabilities more. Outflow of funds are more. Bank has to pay so much more. Example, you see, Bharat Bank 500 crore maturing asset, but maturing liabilities are 650 crore in the next month, maybe in another 15 days. So they will calculate. How they will come to know? Because it is all computerized. Software has been designed in such a way. The moment you open a deposit, SP account, it will classify in a different way that will discuss in balance sheet management. Automatically, it will classify in the respective buckets. Okay. SP current account, you cannot put in a particular bucket. That is RBI rules are there. But time deposit, automatically it will house loan 30 years, will put in the over 10 years bucket. CCOD, it will classify in 1 year bucket. So the software automatically, that is balance sheet related question. That is simple question also they are asking. Understood, friends? Now, maturing liabilities are 650 crores, but maturing assets are 500 crore. Now, bank cannot afford to be happy because you have to arrange funds to meet to manage the deficit. Correct, I think the family expenses are 50,000 month, but family income is 40,000 per month. Family will be in trouble. Okay, surplus, you will be happy. So the answer is what? A is the answer. Answer is A. Agreed? Understood? Okay, very good. Okay, foundation strong mean, yes, you can raise a very, very big building. Now, SLR securities, very important. What are the characteristics? These are the characteristics. Gudant is saying that. I think he's a good man. How you define a good man? Yes, a good man is one, he is not bad. Then how you define a bad man? A bad man is one who is not good. Okay, similar way, what is SLR securities? These are the characteristics of SLR security. SLR means statutory liquidity reserve. You have to keep some funds, yes, liquid and risk free. So these are the characteristics of, yes, which are SLR? Next question. Which qualify for SLR security? Yes, low return, correct. Low return, because generally compared to other securities, government securities will offer you less return, but high safety. Less return, high safety, and high liquidity, because government of India, easily tradable. You can convert to cash. Anybody will buy. Okay, zero risk. Okay, so all the four are, so the answer is all the four are characteristics of SLR securities. SLR securities mean instruments, investments. Anyway, they call it SLR securities. Now, next question is eighth one. What are the, okay, this is a limit used for, one question that will come in between. Okay. What are the limits used for managing risk in trading deals in treasury operation? The treasury people, the first slide we saw, they will do trading also. What is trading? Sometimes they will buy treasury bills, okay, or government of India bonds. And before the prices, they will buy at a lower price, or they will buy dollar or euro, buy dollar at 75, sell dollar at 76. So 1 rupee profit. Sometimes it may be a loss also. Okay, so these are called as trading deals. For example, you are investing in Reliance shares at 800 rupees. But within 2 days or 3 days, it becomes 1000 rupees. So 200 rupees per share you are gaining individually. Similar way, bank also will do trading operations. But trading operations are with risk factor. To manage the risk, you should do necessarily. Otherwise, no. If you are afraid of risk, you cannot generate any income. Correct? But calculated risk. You have to measure the risk and you have to be little cautious, remain within the limits. So how you are managing trading deals? So the answer is cut loss limit, also called as stop loss. This is a purely theoretical question, but this will help you to get 1 mark. Okay, cut loss, yes. Cut loss means stop loss. Stop, STOP, stop loss limit. Even for stopping loss, the board will fix a limit. Deal size limit. Each deal, don't go for $10 million. Such a big deal, don't do. Suddenly, $1 becomes, yes, the rate goes adverse. You will be, our loss will be gigantic. So the deal size also is a, yes, open position. What is open position? When you buy, you have to sell, or when you sell, that is known as short selling. When you buy, it is known as long, going short. The long position has to be wound up by going short, or short position has to be set right by going long. I think all of you are remembering the technical words which we used in international banking. Going long means going on buying. Going short means selling the securities. Okay, disposing of the securities. So the open position means if there is a difference between what you buy and what you sell, that is known as like your inflows, outflow. That is also known as what? Open position. Open position means gap between inflow, outflow, gap between purchases and sales. These are known as open position. That also they will limit. C, D, A and B together. A and B together. Okay. E, A, B, C together. Now what will be your answer? Anyone can give? What will be your answer, boss? A, B, C.
A, B, C together.
Very good. Great. He is the correct answer. All three limits simultaneously will be used. One cannot, okay, you cannot ignore this, you cannot ignore this, you cannot ignore this. So all these will be taken into account by the treasury people. Otherwise, they will be, yes, it's a very important, no, bank will face so much loss. Don't exceed the limit. Okay.
Sir,
So that is
excuse
the
me.
question is-
Excuse me, sir.
Yes, sir.
Sir,
Yes, sir.
Viswanathan is asking example for open position limit.
Open position. Open position mean what the difference between supposing the bank is buying $5 million. $5 million from interbank markets, from Bank of Baroda, State Bank of India is buying. They will do trading. What is trading? Just to buy, just to sell, without the need for, without customer needs. Customer is not wanting this dollar. This dollar is purchased from the market or share is purchased from the, I think most of you will do share trading. What is share trading? Just like that, you will buy Reliance at 10 o'clock, and before 2 o'clock, the rate goes up, you will try to sell. Or next day it may pick up, you will try to keep it for the next day. So that difference between, supposing you have bought $5 million purchase at one rate, 74. But you have not sold. You thought, okay, you have bought $5 million. Yes, but you have not sold. Why you have not sold? Now market is not favorable. You have bought at 74. So you are waiting for the rates to go up. When you have bought at 74, at least 74.10, if it comes, you will sell. So you are waiting, no? So that waiting, at that point of time, your position is open. What is position is open? You are exposed to your risk. Okay, open position means open position. Position means daily purchases or sales in a trading transaction. If the difference is there, both are equal, mean you are out of risk. When you purchase more dollar, you are not sold because the dollar may go this way, that way. So that is known as open position. The open position may be positive, again, liquidity, positive liquidity, negative liquidity. I think this we have discussed in international banking. These questions are frequently being asked. What is open position? Correct. What is positive position? Positive gap. Position mean gap, friends. Please remember, they will call it open position mean gap, open gap. Gap mean difference between what you buy, what you sell. Understood, friends? Okay. Yes, boss. Understood? Okay. Okay. Examples I have given. So the ninth question is, which of these is not a SLR investment? This is very important. Every time there will be a question on SLR, because you have to identify which is SLR, which is not SLR. Okay. I will give the list. Now I think you can immediately A, B, C. I will read. Okay. Just for example, I am listing so much. But in the exam, this many listing will not take place. Only 5 listing they will give. 5 options they will give. Number 1, CMB. What is CMB? Cash management bill. Okay. Whether I will not. Okay. I want the answer from you. Remember, it is similar to a treasury bill. Treasury bills are in 3 maturities: 91 days, 182 days, 364 days. The CMB is a new instrument to temporary mismatch by the government of India. Sometimes government may need 15 days, they may want surplus. So the CMB bills will be issued. CMB means cash management bills will be issued by, like a treasury bill, auctioned by Reserve Bank of India to investors. So that is also qualify for SLR. Okay. Second one, balance with the Reserve Bank of India in excess of CRR. CRR is only 3%, but you have some money also you have invested in, you put it in the current account. Current account, you keep more money. Oh, he is keeping so much money, nobody will give interest. Okay. Whether that will qualify for SLR. Reverse repo with RBI, whether it qualifies for SLR. Treasury bill 91 days tenure, whether it qualifies for SLR. Central government securities, whether it qualifies for SLR. State government's SLR, whether PSU bond. Now what is your answer? Which is not, you have to find the odd man out. Which is the odd man out?
G, sir, PSU bond.
Very correct. Appa, you are sharp. Sharp man, boss, razor sharp. So G is the odd man out because all others are SLR securities. Very correct. Wonderful. This question repeatedly being asked, be alert. Okay. They will tell which is among these is not a SLR security. That is a question they will ask. Okay. 10th question. This is arithmetic. Now all of you can try your luck. Okay. A bank is a simple, very simple. Within 20 seconds, you should be able to calculate. You see, a bank has 20% in SP. That is 20% of the deposits. 100 rupees deposits mean 25 rupees in SP account. On SP account, they paid 3.5. Agreed? Okay. It's just an example. Sir, 3.5 nobody is paying. No, you say, I'm giving you arithmetic. And interest 15% in interest and 15% in CA. You have to read very carefully. 25% in SP, 20% of the 20% mean 20% of the deposits SP CASA. So 15% in CA. So the CASA is 40%. 20% SP, 15% current account, CASA 40. For SP, there is a cost. For current account, no cost. The rest means what? 25 plus 15, 40 over. 60% in term deposit. Average cost is 6.5. Now the question is, what is the weighted cost of the liabilities for the bank? Weighted liabilities for the bank. Now I think you can calculate, but first one, I will try to, this is arithmetic friends, 20-30 seconds only you should take. First one, SP how much? 25%. You assume 25 rupees. 25 into 0.035. Always interest you try to convert to decimal. Then you quickly have to convert. 11% in 0.11. 10% in 0.1. 5% mean 0.05. 3.5 mean 0.035. 0.035 divided by 100. So 25 rupees into 0.0035. So the cost of SP is 0.875. Agreed? Step number 1. Current account, 0 cost. Okay. The remaining is SP, 60%. For 60, how much you are paying? 6.5%. Converted decimal. 0.065 into 60. 3.9. Oh, sorry. Here one decimal. Actually, 3.9. So what is the overall cost? Overall cost is 3.9 plus 0.875. 4.775 is the overall cost of, oh my God. One terminal, please mute. Okay. Who is that? Okay, please. Okay, because I cannot see you. Yeah, because I'm in full screen. Okay. When you want to put a question only, you put, but immediately don't forget to put your mute button. Okay. So the overall cost for your liabilities for this bank is 4.775. Correct? All of you are familiar with this model, is arithmetics. Yes or no? Shall I move to the next one? Any doubt? Because this is a calculation part, numeric. Yes or no? I want at least one yes. Yes.
Yes, sir.
Okay. Now 11th one. 11th one, yes. Similar way, another question. Here I am coming to the asset side. Asset side, now all of you try to calculate. Okay, it will take time, but it is better always go by, yes, interactive mode. Okay, a bank gets 6.4 on SLR. 18% they are investing in SLR and the return is 6.4. Okay. Loans and advances, 7.2. Oh, they are getting only 7.2 return on loans. And the CD ratio, indirectly they are telling CD ratio 65. What does it mean? 65 rupees the loans and advances. That's all. What is CD? Immediately you should remember. Credit deposit ratio. And sometimes CD also stands for certificate of deposits. Here CD stands for credit deposit ratio. What does it mean? Out of every 100 rupees, bank has given 65 rupees as general advances, bills, retail loan, all these are 65. On the 65, what is the income? 7.2. The cash They are keeping cash, idle cash. Cash, no return, 2% unnecessarily they are keeping. CRR, 3%, that also no income. And 6.6% on other investment, earns on non-SLR investments. This is actually one word is missing. Other investment other than SLR. SLR is also investment. And earns on non-SLR investment, average 6.6. Now, what is the average return on assets? This is the question. Okay, friends, shall we go step by step? I think one terminal, please mute. So, number one, SLR income, 18 rupees we are putting in SLR. 18 into 0.064. What is 0.064? That percentage converted decimal. So 1.152%. Okay. Quick step by step. Cash 0. 2%. Unnecessarily we are keeping cash. That is why keeping cash idle in the branch, it doesn't generate any income. That is why don't keep more than what is required. You have to remain. Okay. I think all of you remember. And the third one, CRR. You are keeping mandatory cash at the Reserve Bank of India or your currency chest. Whatever amount in currency chest only will qualify for CRR, not the cash kept at the branch. Okay, so cash kept at the branch level, 2%, zero income. CRR also zero income. So how much is gone? 18 gone, 20, 23 gone, and 65 rupees. On 65 rupees, how much income? 0.72. Oh, sorry, boss. Who is that? Please mute. Friends, please mute because the background noise will disturb the presentations. Oh, I asked you to interact, but it means please immediately put your yes mute button. I think yes. Okay. Loan 65 rupees loan. On that 0.72. What is 0.72? 7.2 has been made 0.72. Now how much is remaining? 65, 68, 70 and 88. Now remaining is 12%. Remaining is 12 rupees is remaining. 12% is remaining. On that what's the income? 6.6. That is 0.066. So that becomes 0.792. So the overall income for the bank in terms of percentage for every 100 rupees assets, income yielding assets, that is risk sensitive assets, is okay. Yes, you total all these 1.12. Take your calculator. You have to work out 4.68, 0.792. Your income is 6.624. Okay, so this is your interest income. That is NII, NIM. Normally, they will ask another question. NIM. What is NIM? Net interest margin. Net interest margin will be always in terms of percentage. But NII always will be in terms of quantum. How much crores? Okay. So question number 11, if you understood, yes or no? Okay. Question number 12. Anyone who, okay, because this is the base. Okay. Understood? Okay. 12th one. Benefits and risks of investing in equity market. Everybody knows, but when the question is asked, you should be able to answer. Whether investing in equity market, good or bad, how many of you tell good? Yes, good in one way, bad in another way. Because it is give you two
More
benefits.
return, more return, more risk.
Yes, it gives you capital appreciation also, and it gives you dividend cash flow also. No other market will give you this one. Suppose you invest in debt market, only interest income you get, no appreciation. But when you invest in share, there are two ways you may be benefited, but both are uncertain. That's the beauty of equity markets. Okay, the two-way income. Okay, that may be capital appreciation. What is capital appreciation? Today you are buying Reliance share at 1,000 rupees. Within 10 days, within a week, it jumps to 1,200. Infosys shares are going to 1,200. That is called capital appreciation. What is dividend? Whenever the company earns very good profits at the end of the year, they will share the profits with the shareholders by announcing some percentage of profits as dividend, 15% dividend, 20% dividend. Oh my God, you are getting so much income. So that is a two-way income. That is why people are mad after share market. But some people go mad after investing, because sometimes invest in capital market, equity market, sometimes wipes of your capital also. Okay, either A or B. Answer is both A and B. So what is your correct answer? The answer is D, both A and B. But it's a high risk. Risk is both are uncertain. Capital appreciation is there, agree. Dividend will be there, agree. But both are not sure. That is the beauty of equity markets. Equity market is also known as a share market. But capital market it includes debt market and equity market. Equity is also a form of capital. Debt is also a form of capital. Debt capital, equity capital, share capital. Okay, both are used for doing business. Okay, 12th one understood. 13th one. Now, primary market instrument. These are some questions they are asking in IPO. I think now LIC has gone for IPO. What is IPO? Initial public offer. Primary market instrument. What is primary market? Initially, it is issued by the companies, NSDL, CDSL. Okay, that is known as primary market. What is secondary market? Once the issue is over, it is listed in the markets. It's just a terminology, because the questions will be on, yes, these terminologies also. Okay, arithmetic also sometimes they are asking. What is primary market instrument? IPO, FEO, rights issue, all the above. So the answer is D, all the above. Okay, yes, IPO mean initial public offer. The FEO mean follow on public offer or further public offer. Rights issue mean in existing shareholders will get a offer first. That is rights issue mean is being offered to the existing shareholder. The shares are, that is at a concessional price or the same price. That is known as rights issue. So the answer is primary market mean all the three are primary market, just for idea, because sometimes some questions will be asked. Now, how this is another important question. Now, because of the MIBOR, Mumbai Interbank offer rate, it's a benchmark rate followed in India. Now, who is deciding? Answer will be 1, 2, 3, 4, 5. Okay, so answer will be based on RBI reference rate. No, RBI will not control MIBOR. Based on ongoing call money market rate. Call money market is call money rates are purely market based, supply and demand. Okay, based on inputs received from a panel of 30 bank and primary dealers. Oh, this appears to be correct. Based on ongoing LIBOR rates. LIBOR means London Interbank. That also now concepts are getting changed. Now MIBOR is basically based on 3. Answer is 3. Okay, based on inputs from panel of 30 banks and PDs. PD means primary dealers. The banks authorized to, I think that question also they will ask. Note down. PD mean primary dealer mean the banks authorized to, banks are financial institutions authorized by Government of India or Reserve Bank of India to buy or sell or to trade with government securities are called Treasury, PDs,
Sir,
like
one doubt,
AD.
sir.
I think
One
all of
doubt,
you know AD. AD means what? Yes, sir.
One doubt, sir.
Doubt. Yes, sir.
MIBOR is used for which one?
MIBOR is as a benchmark rate for pricing or assets product. That is your loan. Loan will be sometimes, or some investments will be based on the return on investments will be is a benchmark rate for pricing or assets. Okay, not for liabilities. It is used. It is mostly it's a benchmark rate used for the pricing. Pricing means what should be the return on your loans or interbank deals. Normally, interbank borrowings or investments will be based on MIBOR. Okay, not banks. Banks will not normally use MIBOR, but interbank. Supposing Canara Bank is borrowing 1,000 crores from call money market. Call money market also not linked to MIBOR. It is a independent. Okay, MIBOR is a benchmark rate used generally for interbank placements or interbank borrowings. Okay, it's a benchmark plus MIBOR plus or MIBOR. MIBOR is like a LIBOR. I think all of you are familiar with the word LIBOR, London Interbank Offered Rate. That is between one bank to another bank. It's not for customers. But that is treated as a reference rate. It is also called as a reference rate, benchmark rate, MIBOR. Okay. Now who is deciding? Not one bank is deciding. It is based on, yes, is a meaning, average. They will take out the, like LIBOR. LIBOR also not one bank is deciding. So many banks are joining and all the rates will be pooled together and they will screen out the lowest and the highest and they will arrive the average. And now one organization I will discuss with you, that is Benchmark India Limited. That is one organization that is primarily responsible for announcing or fixing or arriving the benchmark rates. This is one of the benchmark rate. MITAR. Sometimes MIBOR, MITAR, Mumbai Interbank TAM lending rate, TAM offer rate. That is TAM loans. For long-term loan, MITOR. So many benchmark rates are there. So MIBOR is very popular. Mumbai Interbank offer rate. Agreed, boss? Okay. Now question number 15. Biggest investors in domestic market. Sometimes this question also they're asking. Red herring prospectus, green shoe option. Some funny words, some odd sounding words, questions will be there. Just to alert you. The biggest investors in domestic market and how much they can invest in an IPO. Supposing there is an IPO, LIC IPO, maybe 10,000 crore, for example. Reliance IPO, Jio IPO. IPO means initial public offer. Now it is open to not 100% FDI. 100% FDI means no domestic investors can invest. But it's an IPO. Now the question is a treasury subject. How many biggest investor in domestic market? Normally they are called as QIB. Please remember QIB. What is QIB? The expansion is qualified institutional buyers. Qualified institutional buyer. Buyer means investors. Normally they have got huge fund. Who are they? Insurance funds, mutual funds, pension funds, and PF funds. These people have a lot of money. They have to invest, and they will do all operation because they have got huge money in their disposal. So those people are normally they will invest in big IPOs. And how much they can invest? 50% of the IPO size. Please remember, they cannot invest in 60. Yes, IPO size is SEBI guidelines are that SEBI. The IPOs are normally regulated by SEBI, the Securities Exchange Board of India. And one or two questions sometimes they are asking in the equity market also. That is why, because you should not take chance. I'm including all possible questions. 4 models you watch. Today is the first one. I think mostly 300 questions I am giving to you. Today itself 60 questions. Whether we discuss or not, I will upload. Okay, because we have to, yes, okay, yes. So the answer is the QIBs, these are the QIBs. Maximum they can invest in 50% of the IPO. The remaining 50% should be available for small investors. If the entire thing is invested by these people, small people will not get anything, that is why. Okay. Yes. Now this is an arithmetic question. A share is expected to be numeric problem. Simple problem. Now you have to use a formula. I think all of you remember the compounding formula, discounting formula. All of you, if you remember compounding formula, discounting formula is ulta. Compounding, PN is equal to, I think all of you remember, I think it will come on the screen. Now it's a discounting formula. A share is expected to be quoted at rupees 1,500 after 1 year. Not now, after 1 year, this is the price. At what rate you can buy today if the expected return is 15%? It's a simple question, please remember. That is after 1 year, the price of one share may become 1,500. There is a risk. Now, you are expecting, 15% return now nobody is. For arithmetic purpose I have given, but share market you should expect more return, 5% return you don't expect in share market. Share market you should expect more. It's one of the very vibrant markets in India. Sensex going up. So you want at least 50% rise. So at after 1 year it is going to be 1,500. I want at least 15% return. At what rate I can buy today? This is a question. So the present value is equal to expected price after 1 year is 1,500. What is the present price? The present value PV. All of you note down the formula. PV is equal to, I think the formula I am giving you. The formula used is PV. PV means, note down, present value is equal to the future value. PN mean the value at the end of the nth year. That is how it is called as PN. PN, okay, the N will be small letter, P will be principal amount. This is PV, this may be capital letter. PV mean present value is equal to future value divided by, because the present value will be less than the future value. 1,500 after 1 year. Today value will be more than 1,500, less than 1,500. Today value will be less than 1,500. So you have to now discount. So the formula is compounding mean Pn is equal to P0, P original into 1 plus R to the power n. So here PV is equal to Pn. Pn mean 1,500 divided by 1 plus R to the power n. N mean here 1 year, after 1 year. So the formula is 1,500 divided by 1.15. What is 15%? 15% I have converted decimal. 1 plus R. The formula 1 plus R. If you familiarize this formula, I think 5 marks assured. The PV is equal to Pn divided by 1 plus R to the power n. This is to the power n. Okay.
Excuse me, sir.
Yes, sir.
Sir, if instead of 1 year, if it is after 3 years, what will be the
to the
formula?
power n, boss. To the power n. N will be 3 years.
Okay.
Suppose
The same example you just how to work it.
Correct. Yes. Suppose a bond. Okay, sometimes you are very correct. Sometimes a 3-year bond face value is 1,500, boss. The face value of a bond will be different. And the share will be different.
Okay.
Share will go on appreciating. Bond, there are zero coupon bonds are there. There are different bonds are there. What is zero coupon bond? You invest today less amount, 900 you invest today. After 1 year or after 2 years, you will get 1,000 rupees. So today you are investing at a discount. Your discounted value you are investing. After 2 years, you will get the face value 1,000. So the 1,000 rupees, you have to calculate the present value. Okay, the formula is same. So sometimes, this is a 3-year bond. Your question is very correct. Suppose this is a 3-year bond, base value is 1,500. What is the present value? 1,500 divided by 1 plus R to the power 3, to the power 2, to the power, okay. Sometimes the bond mean the question will be, I will give you all the varieties, just wait, okay. So you understood now?
Sir, once again. Please go, how to calculate in calculator for 1,500.
Correct. All of you take your calculator, pass. Live. Very good. So you put 1,500. 1,500, all of you key in. You will see in your LED panel, 1,500. Okay. Now you put divide button, not put multiplier button. Now put the divider button.
Okay.
And divided by 1.15. If you put equal to, you will get 1,304. This is the first year. You have discounted our 1 year.
Very good.
Now, don't disturb the screen. Now you press equal to, this is to the power 2. You will get 1134. Are you getting? 1134.
No. 1304?
1304. Again, you divide by 1.15. That is supposing to the power 2. If the quoted 1,500 after 1 year, after 2 years mean you have to discount twice.
First year 1304, second year 1134 I am getting.
1134. Again, suppose it's a 3-year mean, again you put equal to, if your calculator has got that memory, you will get check out 986.27. Are you getting?
Divided by 1.15. Yes, sir. Exactly.
This is known as discounting. Compounding, discounting, both are opposite. I'll give you a lot of examples. Now, have you understood this? Now,
yes,
after 1 year, 1,500. So instead of after 1 year, after 3 years, 1,500. What is the present value? 986.27. So today, if it is quoted at 986.27, you buy it. Suppose it's quoted at 900, also you buy it. Because quoted at discount. Suppose instead of 986, if it is quoted at 1050, don't buy it because it's quoted at premium. Premium discount mean a price lower than the market value, present value. What is premium? A price higher than the present value, that is known as what? Is a notional value of the bond share as on today. Okay, you are discounting 1 year, 2 year, 3 year. Formula is same. Agreed, boss? I will give you a lot of practice question. Now 17. What are hybrid instruments? Not hybrid. Hybrid. The answer is same. Answer is very simple. Sometimes simple question also they will ask. Because a funny word. That is why they are asking. Hybrid instrument. But hybrid instrument, not high yielding investment, no. Shares of high growth company, no. Government bonds, no. Combination of debt and equity, this is the correct answer. Hybrid mean dual character instrument. What is dual character? Also in debt, also in equity. Convertible debts, convertible shares. Note down. Convertible shares, also a hybrid instrument. Convertible debentures, also a hybrid instrument. What is convertible? Convertible means what? Debt can be converted to equity, shares. Share can be converted to debt. These are known as what? Hybrid instrument. Why I am asking you focus for this? Some funny words, some odd sounding words, always they will ask in interview. Always they will ask in exams also. Have you understood or not? What are hybrid instruments? Combination of debt and equity. That's the meaning of hybrid. Okay. Or neither, it is a dual character. Don't tell neither a debt nor it is a characteristics of both. Characteristics of both debt as well as equity. What is debt? Interest you will get. Equity, what you will get? You will not get interest. You will get dividend. But dividend is not Saturn. But interest is Saturn. Interest, you are assured of interest if the company is good. But equity, after the balance sheet phenomenon. But the interest is accounted before balance sheet, P&L account. But equity is dividend will be declared after the balance sheet is prepared. If they are having profits, then only you can expect a dividend. Some companies will not give dividend. The other day we discussed risk management. Some companies are not, some banks are not permitted to declare dividend because their core capital will be very low. Understood? 17? Okay. Now 18. Answer is D. 18. What are perpetual bonds? Some terminology I think perpetual bond you are all familiar with. We got tier 1. Okay. That is perpetual, non-cumulative, perpetual, cumulative. Okay. What is non-cumulative? What is cumulative? I think all of you remember that basic thing I am not explaining. Cumulative bond, non-cumulative. What is cumulative bonds, boss? The interest will be keep on being added. It will be compounded. What is non-cumulative? It's like a fixed deposit. Fixed deposit will happen every month or every quarter or every half year or every year. The depositor will withdraw the interest. So the principal will remain as principal, only no addition. That is known as non-cumulative. Cumulative, non-cumulative. So perpetual bond means what are the answer? Okay. Now what is the answer, boss? High yield investment.
D, redeemable anytime.
Redeemable anytime. Oh, boss.
How long?
Call bonds, boss. Perpetual bond mean, okay. Now which one you feel correct, boss?
Indefinite
One more
maturity.
option is there, I think. One more option. Oh, answer is
Indefinite
C.
maturity.
Have indefinite maturity. Unspecified maturity. That is perpetual bond.
Everlasting.
Okay. Everlasting. Okay. They will not put the maturity date, boss. Do you think, are you receiving deposit receipts? Suppose one customer is coming and putting a deposit 1 lakh rupees. What you are writing? Received 1 lakh at rate of interest so and so. For a period, due date are you putting or not? If you simply tell received 1 lakh at this much rate, you are not putting the maturity date. Then that becomes a perpetual bond. Perpetual bond, individual investor will not invest. Only big people, qualified institutional buyer like these pension funds the mutual funds, they are investing in perpetual bond because the normally rate of return will be high because you are not sure about the perpetual bond. And in perpetual bond, there are two options are there. Call options are there, put options are there. These are the questions they will ask. Please remember, these are the questions they will ask. What is perpetual bond? They will ask in interview also. And what is a call option bond? They will ask. What is a put option bond? They will ask. Wait. All these are coming. So the answer 18 is C. Agreed? Agreed? Okay. Now question is, okay, also known as dated bonds. Next question, zero coupon bond. This terminology you have to remember, then only you will be able to go to the arithmetical part. Because they will give ZZB, that is a zero coupon bond, they will tell. Okay, and cash flows they will tell. And duration you have to calculate. I think all of you will remember Macaulay formula. You have to find out the duration analysis. Okay, we'll don't wait. We are basic 18. Now question number 19. And now what is the answer? I will give all the four options. What are dated bonds? Anyone can. Okay, don't guess. Whichever feel, don't feel.
Sir, answer
shy.
is B.
B,
Have specific maturity.
Yes, correct. Answer is B. All government bonds are dated bonds, normally called as dated bonds because it will have specific maturity. Okay, and again, please remember, government bonds have got now longest maturity up to 40 years. Believe it or not, 40-year bonds also government of India is giving. This is specific dated bond, but the maturity period will be as high as 40 years. Okay. Yes, government wants the funds, it is safe. Because who will invest? Individual people will not invest for 40 years. Pension fund and other big people, they can invest for 40 years. Okay, now question number 20. Here also I am giving options. 1, no interest prefixed, no interest rate prefixed, whether that is zero coupon. Oh, that is zero coupon mean, that is the meaning? No. Yes. No interest if redeemed prematurely. Oh, that is zero coupon. Okay, no. No interest cash flows till maturity. Oh, okay. We'll see the other option. No premature closure provisions. Oh, that is a zero coupon bond. Okay, it's a funny word. That is why they will ask. What is zero coupon, boss? Any guess? Any answer? Huh?
C.
Yeah. C is the answer, friends. C is the answer. Okay. Yes, I will share with you because in zero coupon bond is like a cumulative deposit. Otherwise, no interest will be given to you in between. Quarterly interest you cannot draw. Half-yearly interest you cannot draw. Yearly interest you cannot draw. Invest, the interest will be added and you will claim the interest on the maturity. That is why it is called as what? Zero coupon bonds. Okay. Yes. Okay. Yes. Now 21. Very good. Now question is, yes, this is arithmetic. Now all of you can take your calculator. A zero coupon bond, 8% coupon rate. Now here you have to remember some technical words. Coupon rate, yield to maturity. These words you have to remember. What is the difference between coupon rate and yield rate? Note down. Coupon rate is the rate announced originally by the issuing company or issuing bank. Note down. 8 coupon rate mean is nothing but interest rate. 8% coupon rate, 1 year zero coupon bond, 1 year zero coupon bond. 8% coupon rate means they are announcing 8%. But it's a trade of it. It's a freely. Some bonds are liquid. It can be secondary market. Secondary market means one person will, supposing he wants money like a second-hand car. I have got a car, but I want money. Immediately I will sell it. Okay. So this car market and all not regulated, but this bond market highly regulated. It is traded on the screen. Okay. Okay. Now you see 8% coupon rate, face value 1000. Face value means what? At the end of the maturity only you will get 1000. Today you will not get 1000. When you get 1000, after 1 year you will get 1000. In between no interest income. Quoted at 935. What is the current yield rate? Whether at premium or discount. So 2 or 3 questions. Sometimes they will create a scenario. 5 marks they are asking. But if you are very, fundamentally when you are strong, now you ask. Okay. Now you have to use the formula, same formula. Now all of you take your calculator. All of you take your calculator, boss. Yes. You key in 1000, put your divider button, and divider button you put, then you key in 1.08, you key in, put equal to, how much you are getting? All of you try. All of you, how much you are getting?
925.
925, 926 you will get. Correct? All of you are ready? So what does it mean? If you invest 926 today at 8%, you will get 1000 rupees after 1 year. That's the meaning. Okay, in between, no interest. Now, this is the value. This is the notional value or is the real value based on the coupon rate. If they are, because the company is assuring 8% coupon rate. Some fixed coupon will be there, floating coupon will be there. Again, they will twist the question. Fixed coupon, floating coupon. What is floating coupon? Fixed coupon mean during the tenure, they will not change the rate. 8% mean 3 years mean 8%. Sometimes it will be a floating coupon. Floating coupon means what? Every 6 months or every 3 months, they will announce. They will change in between. That is called as floating rate bond. Okay, floating coupon bonds. Okay. Now this okay. Now whether it is floating or not, unless if they are not giving, you assume it's a fixed rate. 8% coupon rate, so you get 926. But is quoted today. Quoted mean depend on market situation. Some people are today they are the value of that bond is 935. It is traded at 935. Then it is at a premium. Now it is at premium. Understood or not? When premium mean when you are investing something more than the real value, then your yield rate will be less. Your yield rate will be, what does it mean? Today, if you invest 935, your 926 mean you will get 8%. But 935, if you invest today, you will get 1000 after 1 year. So, what is the current yield rate? Current yield rate is 65 rupees you are getting income. What is the 65? This is the notional. This is the real rate based on the 8%. But now today it is traded at 935, no, more than 926. It is a traded at premium. Then your yield rate will be less than this. When premium means less than this. Now what is the premium? Yes. How much premium? 9 rupees premium. 920 is the real value and it is quoted at today traded at 935. Now if you invest 935, because the market is now everybody is 935 is the basic question, you will get 1000 after 1 year. So 65 rupees income you are getting. And how much you are investing? 935. Just to press your percentage button, you will get 6.95. In calculator, you key in 65. How we got 65? 935,000. 65. What is 935? Today it is quoted at 935. That is, you have to invest 935 today, you will get 1000 rupees. So put your percentage button. Just don't multiply 100. Just to put your percentage button in the calculator, you'll get 6.95. What does it mean? If it is 926, you will get 8% return. But when you are buying at 935, your return will be reduced. Your return will be less than the coupon rate. So that is a theorem. The theorem is, this is a theory. This you memorize. All of you please memorize. What is the memorize? When a bond is traded at premium, you note down. You see this example. When the bond is traded at premium 935 it traded, yield rate will be, this is a yield rate will be less than the coupon rate. And when a bond is traded at a discount, instead of 935, if it is traded at 915, then it is at a discount. Discount means at a price lesser than the market price. This is the ostensible price or is the notional price. The real price as on today will be 926, but it is quoted at 935 mean premium, 915 mean discount. When the bond is traded at discount, yield rate will be more than the coupon rate. Now, how many of you understood the basic theorem? So your treasury, 2 or 3 more questions you can easily score if you understand these calculations. Simple calculation only. Yes, sir. Understood? Shall I go further? Yes or no? Any doubt? Because that is important. That is why I am staying
Sir,
little longer in this.
how can you treat
Ah.
it as a premium, sir?
Premium or discount based on the value, boss. How you got this value? Based on the coupon rate. Boss, 1,000 rupees you are going to get after 1 year. And the coupon rate is announced by the company, announced by the PSU, for example, HAL. HAL is a semi-government, that is major shares are held by a PSU company. So 8% interest they are assuring. Then it is quote, it will be fetching you 1,000 after 1 year. Okay, now don't see this. 935 right now don't see. 1,000, 8% coupon, what will be the real price? So 1,000 divided by 1.08, 926 is the real price. This is the correct price. But correct price is 926. Correct price means this is the real price. For everything there is a price, you know. Yes, real price based on the assured coupon rate. This is the real price. But today it traded at 935. Sometimes, you know, the Maruti car may be 4 lakh. But the Maruti car will be, the real value is 4 lakh. But some people will tell, no, sir, though the value is 4 lakh, unless you give 4.5 lakhs, the 50,000 is demanding as premium. Because I have maintained nicely, you have to pay me premium. So similar way, the bond value is 926, but the bond is today sold at 935. That is a price lower, higher than the real price. Okay, understood. So when it is at premium, this is premium. Then you may ask, sir, when it is a discount. When the real price is 926, supposing today it is traded at 915 or 910 or 900, then it means this bond is traded at discount. Discount means what? Supposing, okay, one car, okay, or one flat, for example, one building, one beautiful flat. Normally they are selling for 100 lakhs, 1 crore. Today, because of some problem, they are selling at 80 lakhs. Now it's a discount, boss. You'll be happy or unhappy? The bond, which is the flat that is really valued 100 lakhs, now today it is sold at 80 lakhs. You will grab it because they are discount. Discount means the buyers will be tempted to buy because their yield rate will improve. Yield rate will be improving. Understood, boss? Now, this is a fundamental factor. That is why I'm spending more time. Treasury is, this is treasury. Treasury, if you understood this theorem, what is the theorem? When the bond price, another theorem I will tell you afterwards. 2 theorems you have to remember. When the bond is traded at premium, yield rate will be lesser than the coupon rate. Yes. Next one, when the ulta, when the bond is traded at a discount, yield rate will be more than the coupon rate. This is the theorem as demonstrated in this example. Agreed? Understood or not, boss? Yes, sir. Yes, I want to get yes.
Yes, sir,
Because I
understood.
don't want to give. Very good, very good. Okay. I hope you are a person the yes audience. Now you come to know. I am giving a twisted question. Same question I am twisting. Our one of our friends was asking, no, sir, it is. And now we look at the question. What is the maturity value of a cumulative bond? Now I am coming to ulta. They are discounting. Now it's a cumulative. Now you have to go compounding. What is the maturity value of a cumulative bond? Cumulative. What is cumulative? Okay, non-cumulative, cumulative. The interest will keep on being added. Face value 1,000. Here face value means you are investing today. That face value is the bond. Normally bond will be purchased at a lower price to get at a, this is like a debenture. This is like a debenture. It's also a cumulative. Bond, debenture both have the same meaning. Both bonds, debenture, same meaning. Bonds are normally issued by government PSUs, government owned PSU. PSU means major shares are held by government of India. But the debentures will be issued by rated corporates. That's a small difference between bond and debenture. Okay. So it is a cumulative bond or cumulative debenture. Bond debenture same. The FV means Today you are investing 1,000 rupees. Coupon rate, coupon 6.4. 3 years compounding. Okay. Semi-annual compounding. Oh my God. Then your formula will be little different. Now, not discounting. Today it is compounding. You are investing 1,000. After 6 months, something will be more. 3 point will be added. 32 rupees will be added. What is 32 rupees? Half year mean you have to divide by 2. Quarterly mean you have to divide by 4. And periodicity you have to multiply by 2. 6 tenure. Why 6 tenure? 3 years, 6 times you will give interest. So the formula will be, this is the formula. PN, compounding formula is, PN mean what? Maturity value at the end of nth year. That's a note down. PN stands for the value at the end of nth year is equal to present value. PO means starting value. That is 1,000 into, now not divider, into 1 plus R. What is R here? 1.064. 6.4 will be converted to 0.64 to the power, not here, here semi-annual. So semi-annual means 3.2 to the power 6. Why 6? 3 years, semi-annual means 6. And this will be half, this will be doubled. I think this will have practiced in your business mathematics also. Apply the formula. Yes, semi-annual mean half yearly. The rate of interest will be, coupon rate will be half and the frequency will be doubled. Suppose the quarterly mean 6.4, but quarterly compounding mean 6.4 will become 1.6 and 3 years will become 12 tenures. Okay. Now how to do in the calculator? All of you want to do in the calculator? All of you do, all of you key in 1.032 in your screen. 1.032 in your screen. Why it's 032? 6.4 has become 3.2, 032. This is the first 6 months value. 1.032 have you got? Into, you put into button, don't put divide button. Into, again you put 1.032. Okay. Now you put equal to button. Equal to button means is the first year value. Are you getting 1.0650? Are you getting or not? All of you verify. Because every one of you have to practice. If you practice this, I am sure you are crossing BFM. So BFM, very simple. Okay. Are you getting or not, boss?
Yes, sir.
1.065 are you getting? Yes or no?
Yes.
Again you put equal to. Again you put mean third of year. Again you put equal to fourth of year. Again you put equal to fifth of year. Again you put equal to third year. So you will get yes 1,208 in your calculator. How many of you got this answer? Okay. So that is very important, boss. How many of you got this answer? Tell me honestly. All of you have to bring calculators. Tomorrow, again Treasury will be there to the same time. Bring calculator. I will make you practice. Okay. Yes or no? Now how many have got the 1208? 1208, have
I
you
got, sir.
All of you got it now?
Got, sir.
Yes.
I got, sir.
Very good. Okay. Now I am changing. I am changing. Instead of semi-annual, this will help you in business ABM also. Now instead of semi-annual, yes, I am changing the question now. How I am changing now? Different question. Okay, same question. I am asking in a different way. What is the effective rate? What is the effective rate in a cumulative bond? Same question. I am adding one more word. What is the effective rate in 1,000 face value? Same coupon rate, same 3 year, same semi-annual. But I am asking one more word. This is a question very often being asked. Effective rate. What is effective rate? Because of the compounding, the effective rate will be, again you have to translate in terms of simple interest. Okay, what is that effective rate? Yes, now you see, it's not 6.4. Because of semi-annual compounding, it will be something more than 6.4. Because interest ka interest. Okay, now how to calculate? Just now you got 1,208. Same, 1,208. Understood? So what is the 208?
Okay.
1000 you invested, 208 you are getting. 208 you are getting at the end of how many years? Now you don't worry about semi-annual, quarterly. Your effective rate per annum. Effective rate means now you have to per annum. So 208 is your interest. Divide by 3. Why you are dividing by 3? You tell me. It's a 3 year. Now you don't worry about semi-annual. While calculating, you applied the formula. Now effective rate means you only divide by 3. How much you are getting? 208 divided by 3 means 69.3 you will get. All of you are getting. This is for 1000 rupees, 69.3. For 100 rupees, 6.93. What is a 6.93? You are investing at 6.4, but ultimately you are getting 6.93. Why? You tell me why. Yes, boss. Can anyone tell why? Because 6.4 simple rate. But because of compounding effect, compounding how compounded? The per annum interest has gone up from 6. It's a simple fixed deposit means 6.4 only you have got. But because of the compounding, you are getting 6.93. How many of you understood? This is known as effective yield rate.
Effective rate. How
rate.
much, sir?
Effective rate.
How
Okay. You think of me, this question will come. It is a question repeatedly being asked. What is that, boss? Boss, total interest you have collected, no, boss, earlier. Earlier, how
Yes.
much you got? 1208. Same question. 1208 you got in, no? Okay. Now, same question in a different format. So, 1208 you have got at the end of that year. But how much you invested? 1000. How the 208? It's a interest. Total interest for how many years you invested? 3 years. You don't worry about the compounded as semi-annually. You imagine it's a compounded annually. So 208 is the total interest at half-yearly compounding for 3 years. The per year, the rate is effective rate per annum. So 208 only you take. Don't take 1000. 1000 is the principal amount. Interest only you take. Divide by 3. Why you are dividing by 3? 3 year you are invested, no? So per year how much you will get? 69.3 you will get. 69.3 for how much? 1000 rupees. For 100 rupees, always percentage mean 100 bus. Percentage mean 100. You 208 divided by 3, you how much you are getting? 208 for 3, how much you are getting? 69.3 will get. Adjust one digit. 6.93 is the overall effective rate. Simple rate mean you have got only 6.4. Because of compounding effect, you are getting 0.53 more. Sometimes how much more also they will ask. Now how many of you understood? One terminal you have to mute. Yes, boss. Your doubt cleared or not? Doubt cleared or not?
Cleared.
Cleared, huh?
Yes, sir.
All of you. Now, can you do the next one? Yes. Now, next question. I am changing the pattern. Now, annual compounding. Okay. Now, effective rate in a cumulative bond, same 1000, same 6.4, same 3 year, but there I use the word semi-annual compounding. Here I am using the word annual compounding. Because of that, it will not be 6.4, something more than 6.4. What is the something? You have to calculate. Same thing, now different formula. Why different formula? Now it is annual compounding. So 1000 into 1.064, there you put 3.2 because semi-annual. Now here annual mean you put only, yes, 1.064 to the power 3 only you put. There you put 6. Now you have to put 3. So 1000 will become 1204. There it becomes 208 something. Now here it is becoming 1204 because annually it is compounding.
Sir, one
Now
second.
how much more?
Sir, 1 second. Sir, 1 second. Sir, first I will do 6.4 divided by 100 plus 1, 1.64 into 1000 Then what to do
1
to
plus
get
R.
1204?
Boss, always 1 plus R. 1 plus R is the formula. What is
Okay.
1? R is always expressed in decimal. 1
Yeah.
is always constant. That will not change.
Okay.
R will be changing. R is how much now? 6.4 divided by 100, 0.064.
Plus
So 1
1.
plus R becomes 1.064. Correct? Agreed?
Yeah.
And to the power 3. In your same calculator, first you are key in 1.064 into 1.064 equal to put another equal to put. Are you getting 1.204? Are you getting or not? Check up.
Not getting, sir.
1.204. That is for 1 rupee. That is for 1.204 for 1 rupee. But for 1000 rupees, 1204 is the, I think, one terminal. Oh, background noise. Your TV volume. TV is running, boss. TV volume at least you keep quiet. Keep low. Okay, 1204 bars. Agreed. Now, have you got 1204? All of you, to check up. Yes, all of you have to calculate, friends. Please.
What is that?
Okay. Because every one of you, whoever logged in, I cannot see who are all logged in. Because the session is for every one of you have to clear the exam this time. No excuse, no compromise. Because we want 100% of you have to pass. Because we have faith in you. Okay, but I know you are highly capable. Okay, so this time don't take chance. All of you are crossing. Why? Because if you are familiar with the fundamental, you are a king in BFM subject. Same way ABM. I will also come for ABM, arithmetics, balance it. Okay. So 204 is the income, boss. Okay. And how many years you have waited? 3 years. What is your average income? 68 rupees. Average per annum is 68. So for 100 rupees, 6.8. Though you are investing in 6.4, your return becomes 6.8 because of the compounding effect. 3-year compounding means this will be even 5-year compounding means it will be still more. 6-year compounding will be still more. 2-year compounding will be still less. So the because of compounding, always the overall interest will improve, return will improve. Okay, understood or not? Now come to the queen question. What is the effective rate in a cumulative bond? 1000. Coupon rate, this will come for your ABM also, Treasury also. Treasury is nothing but investing. Always you have to invest, keep in mind high return, no risk. Okay, you should avoid the risk or you have to adjust the risk. Sometimes there will be confusion between without adjusting the risk, after adjusting the risk. Okay, now 1000 rupees. Now here no risk because there's a bond, risk and all. Okay, that is okay. It's not coming in the question. You are 6.4, but 3 years, same 3 year, but quarterly compounding. What does it mean? There will be 12 intervals. Well, how we got 12 interval? Yearly 4. So the formula is this formula, same formula, but P and P is same, 1000. 1 plus R, 1 plus 6.4, you divide by 4, 1.6. 1.6, again 2 digit to adjust, 0.16. 1 plus R will become 1.016 to the power 12. Why 12, boss? 3 years, quarterly compounding, 3 into 4, 12. Why it is 1 point? This will be divided by 4. So when you do this, key in 12 times you have to key in. First you key in 1.016 into 1.016. Then 8 times you have to put equal to. Sorry, not 8 times, 10 times. 1.016 1 time. 1.016 into equal to 2 times. Then equal to third. Fourth equal to. Fifth equal to. 12 times even you put equal to, check up, are you getting 1000 to 10? In your calculator you can do. Only this calculator you are permitted to carry. Don't carry your mobile.
Sorry to disturb you. Sir, first 6.40 divided by 4 for quarterly.
Okay.
I am getting 1.60.
Yes.
divided by 100 I am putting. Then
How much you are getting,
I have 0.16 plus 1 I am getting 1.016.
1 is constant, 1 plus R.
Yeah.
So are you getting
1.016?
1.016?
Ah.
Okay. Now
Now
you
I
key in
have
1.016 in your LED, in your calculator. Now
again,
we will go together. 1.016 key in your calculator. Are you keying in?
yes, sir.
Key in.
Yeah, again,
You
again.
put you key in into button you put. Into button are you putting? Again, you key in
2.02 I am getting.
again you key in 1.016 you key in. Okay. Now you put equal to button. You will get 1.032. Are you getting? First you try. First equal into equal to you put.
Oh, okay.
Again
okay.
you don't put into.
1.
1.032. Are you getting? Yes or no?
Yes,
This is
sir.
second quarter. Now you go on putting equal to. Third equal to, this is second quarter. Third
Okay.
equal to, fourth equal to, fifth equal to, sixth equal to, seventh equal to, eighth equal to, ninth equal to, 10 equal to, 11 equal to, 12 equal to, you will get 1.0982 you will get. Are you getting or not?
Okay, okay.
So I have rounded to 1210. 1210 because you are investing 1,000 rupees. That 1 rupee 20 is for 1 rupee. 1 rupee, but this is for 1,000. So you will get
Sir, why we have to take a
1,210.
toll, sir?
Boss, 3 years na boss. Boss, quarterly.
Okay.
Quarterly mean 1 year, 4 intervals.
Okay.
1 quarter, next quarter, next quarter, next quarter. So 3 year will have how many intervals, boss? The
Yes,
tenures
12,
will
sir.
be 12 tenures. 3 into 4, 12. And here I am dividing the, yes. Okay. I think all of you are familiar with this model. 6.4, don't put 6.4. Divide by 4. Why you are dividing by 4? Quarterly, boss. Okay. Why you are multiply by 4? Yeah, tenure will be multiplied by 4. If it's a half yearly mean what you will do? 3.2, year 6 will come. Okay. Monthly they will not give. In housing loan, EMI monthly. Monthly mean equated monthly. So the rate of interest you are divided by 12. 3 years, 36 interval will come. EMI mean different formula. Okay. I think EMI formula I will teach you afterwards. Okay. Retail. Agreed or not? Now how many of you agreed? Understood. In your calculator, are you getting 1,210? Yes or no? Yes. You will get. Try at home, boss. Okay. Now, interest alone 210. Interest alone 210. Divide by 3. Now, don't 12 and all you forget now. You have got the value 210. Divide by 3. 70 rupees. 70 rupees per 1,000 rupees. Per 100 rupees, 7%. Though you are investing in 6.4, your return becomes 7. Why your return jumps, boss? How you are getting more? Because of which effect? Quarterly compounding effect. That gives you more return. Understood or not? This is called effective rate of return. These questions are repeatedly will be asked even in aptitude test. Yes or no? How many of you understood, boss? I want at least one yes. Yes, yes, sir. Yes or no?
Yes, sir.
Yes. Oh, very good, very good. Okay. Now come to 25. Now I think we can go up to 25 because time is almost 10. You will become hungry as well as angry. Okay. Sir is extending the session. Your people will be waiting for. Let us be informal. Don't worry. Learn with the fun. Okay. Learning should be pleasurable. Don't feel the pressure. Sir, treasury. No. Sir, international banking. No. All CAIIB subject, you have to love the subject. You like the subject. You get involved. You are clearing. That is my guarantee. Okay. Now you see what rate one can buy a bond. I am changing the question. Face value now is not cumulative. It's a discounting. You have to apply. A bond is getting you 1,000 rupees after 3 years. After 3 years only, it is going to give you bond mean face value. 1,000 rupees you are going to get after 3 years. And it is giving you coupon interest 6.4 and 3 years. And it is annual compounding. Now the question is, at what rate you can buy today? What rate one can buy a bond? The bond is, yes, face value 1,000 bars, coupon rate 6.4, annual compounding. Now at what rate you can buy? You have to buy at a lower rate. That is lesser than the face value. Because 3-year interest will be added, no? Okay, now how to calculate? Formula will be ulta. What is ulta? Here the formula is PV. That formula is different. That same formula, there you multiply, here you have to divide. So present value is equal to, what is the present value of 1,000 is equal to PN. PN means 1,000 divided by 1 plus R. Annual compounding mean 0.64, 1.064, not 0.64, because 6.4 divided by 100, it will become 0.064. Okay, yes, to the power 3. Now you take your calculator, all of you, 1,000 you put, divided by simple way, within 5 seconds we can calculate. Divided by, now you put, don't put multiply. Divided by 1.064, 3 equal to you have to put here. Here why 3 equal to, there you multiplied, so 2 multiplication, that will become 2 quarter. Here you are dividing, so equal to, first equal to you will get 939.84. Second equal to you get 883.31. Third equal to you will get 830.18. That's the answer. How many of you got this answer? Try all of you. Take your calculator, key in 1,000 divided by 1.064, equal to you put, equal to you put, equal to you put. 3 equal to you put, you will get 830. Are you getting or not? Tell me.
No,
Tell me.
I am not getting.
You are not getting,
Yes, sir.
Oh, how much? 1,000 you key in again.
1 second, sir. 1,000 divided
Put
by
the divider button.
1.064.
0.64.
Okay.
Put the equal to button.
I am getting 938.85.
Okay, one more equal to you put. 3 years, one more equal to you put. Don't change anything. You are.
I am getting again 938.84 only I am getting.
Then your calculator is wrong. I think which calculator you are carrying. Okay.
Yes.
Again you divide by 1.064. Again you divide by 1.064.
83.
One answer is that. Again you divide by 1.0.
1.064. Now I am getting 830.18.
That is all. So your calculator, it doesn't have memory. 3 times you have to divide by 1.064. Instead of that, if you have got, your calculator has got inbuilt memory, just press equal to, you will get 830. So today, if you invest at 830, you are going to get 1,000 at the rate 6.4 compounded annually. Same question, shall I twist it? Yes. Same question, I will twist it. Okay, I will twist it. Now, same 1,000, same 6.4, same 3 year, but semi-annual compounding. Now tell me who can calculate. Now challenge. Now tell me who can calculate. All of you try. Now I will make you all do together. All of you key in 1,000. 1,000. Put the divider button. And you key in 1.032 you put. 1.032. Why 32? 6.4. I am, yes. Now you have to put 6 equal to button 6 times. Carefully you have to put. First equal to, second equal to, third equal to, fourth equal to, fifth equal to, sixth equal to. If you put that, try. You will get 827.79. Are you getting or not? Yes, this is how you have to calculate. How many of you are getting, boss? Try. At one, you can buy a bond. Are you getting?
Yes, sir.
Very good. So have a peaceful night today. Don't worry. Treasury made simple. Treasury, you are all cracking. So this I will upload today itself. Shall I upload today?
Yes, sir.
It has got 60 questions. Before you come tomorrow, go through. I will upload all the 4 modules. All will have.
Sir, you can
Okay.
share it with me. I will upload it today or tomorrow morning. By morning, I will send it.
Yes. But this calculating part, if you understood, you are cracking. I'm definitely giving a guarantee. Step by step, you are understanding the steps. And if you are capable of doing all together on screen, okay, yes, you are all cracking. Okay, there is no question. Yes, madam.